Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this in-depth for the Inside Network. Joining me today to explore investing in private equity is the portfolio manager at MLC, David Chan. Welcome, David.
Thanks for having me, Lauren.
So we've seen rates reset quite dramatically in the recent period. How does that affect your world in terms of the businesses you'll look at, the value propositions, building your portfolio?
When people think of private equity, they immediately think of leverage. But within our portfolio at MLC, which is a mid-market focused portfolio, leverage has only ever been a small contributor to returns, less than a quarter of value creation. And so leverage hasn't had a material impact. But what we found very interesting with leverage is that it's created a number of opportunities, particularly in corporate carve-outs today, where some of the listed businesses are willing to sell some of their best subsidiaries, which they wouldn't have let go in the past, in order to pay down debt. We like the mid-market segment because the leverage levels are relatively low, but it still offers a great opportunity for growth in these companies, as well as other levers of value creation.
Imagining the perspective, David, of many advisors, they see the attractive qualities of private equity, but whether it's their investment committee or talking to clients, there's always the concern that for every great success story that you're really proud of, not everything will always be as rosy. Can you talk us through what risk management looks like for you, how you think about the due diligence, but also the partnerships to try and best protect this capital?
Yeah, I think that's one of MLC's real strong points. We're a fiduciary of superannuation capital, and so protecting the downside and ensuring a well-diversified, balanced portfolio has always been part of our DNA. And so a few things we look for. One, we look for secular growth thematics. So these are long-term 10, 20-year tailwinds that will survive those cyclical bumps along the road. We also make sure that we test rigorously the downside cases for all our investments. And so the loss rates across our portfolio are typically less than 5%, which are a lot lower than the overall buyout industry. And finally, for all our deals, we're really focused on alignment of interest, which is making sure the managers and the management teams we partner with are investing a lot of their own money. And so we know because of that, if the deals aren't going well, they're going to hurt as well, right? And they're going to put a lot of focus into helping restore these companies and fulfill their growth potential.
And David, recently we've seen the listed space have a really good 12 months or so. For advisors, investment committees, asset consultants that are now sort of wavering about whether or not to include private equity, what counsel would you give them to rethink?
I think if you look at some of the most sophisticated investors globally, like the US endowments, as well as a lot of the sovereign wealth funds, they're allocating anywhere upwards of 20 to 40% plus into alternates or private markets. I think it's not an either or decision. I think it's a combination. And if you think of the long run, there's a great benefit to that diversification of adding private markets. In addition, if you just look at the opportunity set, the unlisted markets really have a very large platform and wealth of opportunities, with over 8 times as many companies with revenues over 100 mil compared to listed markets. In addition, finally, companies are just staying private longer, right? Less companies want to go IPO because of the volatility, and more recently, the declining stock prices, particularly in sectors like tech and some parts of healthcare. With the pools of capital available in the private markets, companies can really execute their long-term growth plans and reach their growth potential while staying in private hands, which gives a lot of flexibility and freedom for management teams to achieve their longer-term goals.
David, another misconception potentially is that artificial intelligence is so prominent within the PE space. I think a lot of advisors, though, they are looking to get into this theme. I'm sure clients too. So how do you think about that? Is that accurate, that it's the best place to potentially play the AI story?
Yeah, I think AI is going to be prevalent across a lot of industries. We've seen within our own portfolio, it's started to permeate traditional sectors, whether it be finance, manufacturing, industrials, consumer. And it shows up in ways like reducing the cost of customer acquisition, increasing the productivity of your sales force or your existing staff, ensuring the utilization of your plant is higher. So these are ways which aren't obvious at first glance, but they're really the long-term drivers of AI value creation. I think the Magnificent Seven and what you've seen in the US listed markets, there's a fair amount of that that's hype, right? And I think that will show out over time that it's not the best place, in my view, to play that thematic, although it's been a very successful one over the last year. If you think the longer term, it's really AI increasing productivity across a range of traditional sectors. And similar to how you use the internet and your mobile phone today, AI will just be embedded into everyday business, right? You won't be a unique success story for using AI, but people will assume you must have AI as part of your business model in order to be sustainable for the long term.
Finally, we've seen advisors have a lot of confidence about private equity as something to invest in. You touched on so many investors around the world that are succeeding, have some allocation to it. One of the new developments that we're seeing is the growth of the secondaries opportunity set. For advisors that are less familiar, drawing on your experience, what does this mean? What does it offer that's different?
Yeah, the secondaries market really is a very deep and liquid market today. It's been over 100 billion the last 3 years, and this year's probably going to exceed over 140 billion in transaction volume. Half of that is deals into specific companies, while the others are more portfolio traditional deals. At MLC, we're very careful to only buy into assets that we would otherwise buy into on a primary basis. I think the biggest risk of secondaries is you think you're buying something well because you're buying it at a 10 or 20% discount, whereas most assets are priced at those levels for a particular reason. And so really being able to understand the asset and only transacting in secondaries when you really understand the asset is very important. I think on the exit side, MLC has used it in a number of occasions to obtain liquidity on assets ahead of where the public markets or other exit market opportunities arise. And that kind of risk management really helps us maintain a very balanced and risk diversified portfolio by taking liquidity along the way.
Thanks for all of your insights, David, and look forward to hosting you again.
No worries. You're welcome, Laurence.